Hello and welcome back to The Note, and we've had a risk-on start to the week. Stock markets across the world doing very well today, but I'd like to suggest that for the longer term, perhaps the most important point to note is improvements in some of those measures that have most scared people about the emerging markets. If we take a look at this chart, it shows you how the Bloomberg Industrial Metals Index underpins many emerging market currencies, and the JP Morgan Emerging Markets FX Index have done since the beginning of August last year, which was when we began to see the beginning of the near crisis conditions that persuaded the Federal Reserve not to raise rates in September. You can see that in both cases there is a very noticeable uptick now from the lowest levels. Metals prices have gained noticeably, and even EMFX, even if it is still weaker than it was back in August, is showing some recovery. This has to be a positive development. We will see how long it can last. However, the greatest interest today has been in one area where the perceived risks to foreign exchange have increased very dramatically, and that is the UK. If we take a look at this next chart, it shows you how sterling has done against the dollar and against a trade-weighted basket of currencies over the last decade. You can see a very noticeable fall just in the last few days, and that is largely because of the news we've had over the weekend. We now know that there will be a referendum on Brexit, on the possibility of leaving the European Union on June the 23rd. Now, it's not news that we were going to have this referendum. That's been a political commitment for some years. The date is new, and the other critical development over the weekend is that more of Prime Minister David Cameron's allies have decided to campaign in favour of leaving than had been expected, perhaps most significantly because he's a very prominent, flamboyant character, the Mayor of London, Boris Johnson. That is perceived, I think, correctly as raising the risks that Britain does eventually go through with voting to leave the EU. That may have long-term economic advantages for the UK, but in the short term it would create the kind of uncertainty that always roils markets. There are all kinds of difficult, complicated elements to actually leaving the EU that would be bound to raise the risk of accidents and would put people off buying sterling. I'd like to add also, very importantly, if we take a look at this next chart, that there are broader fundamental reasons for the weakness of sterling. We're looking here at core inflation, that's excluding food and fuel, for over the last 10 years for the UK, the Eurozone and the US. And you can see that the UK is unusual both in that post-crisis there were a few years when it really did look as though it had an embedded inflation problem, but that now it really appears to be lapsing back down towards deflationary expectations, deflationary psychology. Core inflation in the UK is now almost as low as it is in the Eurozone, where they are still desperately throwing QE at the risk of deflation. It is significantly lower than in the US, where core inflation is now picking up quite noticeably. That's part of the reason why the Federal Reserve has decided to actually raise rates. Now, this is not good for sterling. It implies that there is a risk that the Bank of England might be cutting rates rather than raising them, as had been expected. It implies that there's a risk of more QE. Therefore, when you look at sterling, there will be some opportunities to make money over the next few months if you're very brave, but broadly speaking, with risks elevated, with great chances that the occasional stray poll will increase those perceived risks, and with the fundamentals not supportive, it's very hard to see sterling do anything other than fall between now and the referendum in June.